There are a number of different ways to purchase a car, and depending on your situation and needs, you want to make sure you get the right deal for you. Hey everyone, and welcome to The Savvy Squaddy. In this video I'm going to be explaining the various different ways to purchase a car, and we'll share some tips on how to try and get the most with your money. This video will be focusing more on buying from a dealership rather than off some randomer on the internet. Remember, the dealerships still need to make money and a profit, so what they offer you may not always be in your best financial interest. Hopefully, by explaining the different ways to finance a car, you can go into a dealership prepared. Firstly then, what methods are there to purchase a car? You can either use cash to buy a car or debt, and there are a number of different options with regards to debt, which I will go through. The option you choose will largely depend on your financial situation. But first, let's talk about using cash and buying a car outright. By using cash, you own the car outright straight away. You aren't limited by mileage, it's fairly straightforward, you can sell the car whenever you want, and it's the cheapest option. But because you own it outright from the day of purchase, you will also face the brunt of depreciation, which is around 50% after 3 years. So you buy a car for £22,000 and 3 years later it'll be worth around £11,000. Also, because you have used cash, if you haven't kept some aside for emergencies, then you could run into issues further down the road. You are also limited with what car you can purchase by how much you have managed to save up. I bought my first 3 cars with cash, and for me it was completely the right option. I was going to buy a third one on finance as it was the most expensive of the 3, but I didn't want to see a good chunk of my savings from 8 months in BAS just disappear. But when the dealer showed me the finance agreement, and I saw just how much extra I would be paying in interest, I declined it and paid cash. It saved me a lot more money in the long run. When I sold the car last year, the amount of interest I would have paid had I purchased it through finance was more than I actually got from selling it. But there is a place for finance, and my current car is on finance. A conscious decision I made, mostly to help improve my credit score, as it is the first loan I've ever had. And no matter how good you are with money and how much you save and have in the bank, if you can't show that you can borrow and repay money on time, then your credit score can be affected, as you have no credit history, which can then affect future loans. So, whilst I could have paid for my current car with cash, I chose to get it on finance to help out my credit score. And in hindsight, it was a great decision, because I then invested that cash and I have made much more money on that than I am paying in interest on my car loan. So what finance options are there when it comes to purchasing a car? I'm going to cover 5 different ways to purchase a car using debt, but bear in mind that only 2 of these ways will give you ownership of the car from the day of purchase, and that is because they are both not dealer financed. Also, by financing, you are paying more for the car than what it is actually worth due to the interest payments. But first, let's go through the 3 dealer financing options. First up, personal contract purchase, or PCP. With this option, you pay a deposit, often around 10%, and then a number of low monthly payments for a set period of time and with interest. Once the contract is up, you can either hand the car back with no extra cost to you and potentially enter another PCP arrangement with a different car, or purchase the car outright with a balloon payment, which can be quite a lot of money and sometimes seem unaffordable. This balloon payment, also known as the guaranteed future value, is how much the finance company expects the car to be worth at the end of the term, and that is based on the make and model of the car, the length of the term, and the annual mileage. The more miles, the less it's worth. It is also calculated at the start of your term, so you know how much you would have to pay when it comes to the end. If you get to the end of your term and your car is actually worth more than what the finance company thought, you could use that difference as a deposit for another car on PCP. You are unfortunately not able to take that difference out as cash. If it happens to be worth less than the balloon payment, then it's best to walk away. With PCP, the amount you borrow is the total value of the car minus the deposit, but the amount you repay is calculated by subtracting the deposit and the guaranteed future value from the total price. But interest is calculated off of the total amount you borrow and not the amount you are paying back. That might seem confusing, so hopefully this example will help clear it up. You want to buy a car for £20,000. You stick £2,000 down as a deposit, as that's 10%, and therefore your loan will be £18,000. The finance company calculates that your car will be worth £8,000 at the end of your 36-month term. Therefore, your monthly repayments are calculated from £10,000, 20,000 minus 2,000 minus 8,000. And because you are only paying back on this difference, the monthly repayments tend to be lower than other finance options. But you still have to pay interest, and that is still calculated off £18,000, even if you decide not to pay the balloon payment at the end, and instead hand the car back or roll into another PCP arrangement. But with this type of contract, you are limited by mileage. If you go over the stated mileage, then you will be charged a penalty. Also, any damage or excessive wear and tear will be charged to you at the end of the term. PCP is a very popular option amongst many consumers. Dealers also love it as they make a lot of money from the interest that people pay from their car finance. With the balloon payment being so large, many people don't want to pay it, and so they decide to go into another PCP arrangement to keep costs low. The dealers love this as they are keeping you in this constant PCP loop for years and earning money from the interest you are paying. But then they can sell on the cars that you decided not to fully purchase. I personally would not choose this option if I wanted to own the car at the end of the term. Up next is personal contract hire, or PCH, and this is essentially leasing the car. The main difference between this and PCP is that at the end of the term, there is no option to purchase the car. You are just purely renting the car for a set period of time. Delivery, road tax, warranty and breakdown can be included, and like PCP, you don't have to worry about depreciation as you don't own the vehicle, and you are also able to change the car more frequently. But like PCP, there are mileage limits, and you will be charged extra for going over the limit, and for any excessive wear and tear. Deposits also tend to be quite a bit higher than that of PCP. PCH is normally for businesses, and because of that, VAT may not be included in the price. So if you happen to go with PCH and you're not a business, you may need to add on 20% to the monthly price to see how much you will end up paying. But the dealer you are buying from should explain this to you. Now, because both of these options do not grant ownership of the vehicle at the end of the term, and because of the mileage limit, I decided to go with the third option with regards to dealer finance, and that is hire purchase, or HP. This is quite straightforward. You pay a deposit, usually around 10%, and then you repay the remainder of the value of the car plus interest over a fixed term. At the end of the term, you own the car outright, and depending on who your finance agreement is with, there may or may not be a small transfer fee for this. However, during the term it is not your car, and if you fail to keep up repayments, it could be repossessed by the finance company. You are also not able to sell before the term is over without the permission of the finance company, and you will feel the brunt of the depreciation. But you are not limited by mileage, and if you aren't really fussed about getting a different car every few years, then this is a great option, especially if you want to own your car outright and keep it for as long as you can. Whilst the monthly repayments with PCP will be lower than those of HP, when it comes to the end of term, the balloon payment will very quickly fill that difference, if not more. So it is important to try and decide what you want for the future in terms of your transport situation, and if using dealer finance, picking the best option for you. Now we have gone through the 3 options of dealer finance. Let's go through the 2 options you have with independent finance. The first one being using a personal loan. This is essentially like buying a car with cash. You borrow the money you require from a bank or a building society or a specialist car loan company and pay it back over a fixed term with interest. The money then pays for the car outright with no need for any deposits. As you own the car outright from the start, you can modify it, do as many miles as you want, and even sell it whenever you want. You are unable to use PCP, PCH, or HP with a private seller, but you can use a personal loan as the money is usually just deposited within your bank account and so acts like a cash purchase. And if you have some savings and perhaps don't want to borrow a large amount, you can use both cash and a loan together to pay for the car. Using a personal loan can be one of the cheapest options when it comes to debt, as interest rates tend to be lower, providing you have a good credit score. I would have used this option when I bought my most recent car, however, due to a certain global virus, my bank was only granting loans to key workers and up to £2,000 at the time, so not enough to buy a car with. So I went with hire purchase instead, the next best option for me. Similar to HP, personal loans do have higher monthly repayments than PCP or PCH, and as you own the car outright from the start, you will suffer from depreciation. You will also be responsible for paying for all of the servicing and maintenance, and if you sell the car, you still have to pay off the loan. The final independent finance option is using your credit card, providing your credit limit is high enough. This is the same as using a personal loan, but some dealers may not accept credit cards or impose extra fees if you use one. Except for the minimum monthly repayment, it is up to you to be disciplined to pay off the debt on that credit card. Not paying more than the monthly minimum repayment can put you into a spiral of debt, and you could end up paying massive amounts of interest. Watch my video Debt and Loans Explained to get a better understanding of how it all works. But you could be lucky and get a 0% interest credit card for up to 22 months and pay it off during that period. After that time is up, the APR shoots up. So, whereas this is an option, it would require some forward thinking and discipline to make sure you don't let that credit card debt get out of control. Personally, unless I had a solid repayment plan and a great deal, I wouldn't use a credit card to pay for a whole car. So there are a number of different financing options when it comes to purchasing a car. At the end of the day, it comes down to what best suits you for your needs and financial situation. But before stepping into that dealership or buying from an online car supermarket, do some research. Find similar vehicles and see what they are priced at. Check the APR to compare different interest rates, and go in knowing exactly what you want. Otherwise, the dealers might exploit your lack of knowledge and understanding and sell you something you don't actually need. Now on to some tips which might help you purchase a cheaper car. First thing to ask yourself is, do you really need a brand new car just off the production line? The level of depreciation that will happen to that new car when you drive it off the lot is crazy. Buying a second-hand car, even when that is a year old, will actually save you quite a bit of money. You might even be able to get an ex-demo car for a great deal. And following on from that, the next point is, have a think about what you actually need in a car. How big is your family? Petrol or diesel? Do you do long or short journeys? Is a large boot needed, etc.? Having the answers to these questions before buying a car will keep you on track and help you not get distracted by potentially other attractive offers to a car that doesn't match your needs. Next up, there is actually an optimum time to buy a car, and this tends to be towards the end of a quarter. So towards the end of March, June, September and December. This is because dealers have quarterly targets they need to meet, and so are more willing to offer better deals. But just don't leave it till the last few days, as they are likely to have hit their targets by then. If you aren't too fussed about having the newest model, then try looking for models that are just about to be replaced by a newer version. These cars will often have discounts on them, as dealers are trying to get rid of them before the newer versions arrive. If you're planning on selling your current car when you get a new one, you will get more money if you do it privately than if you part exchange it. Part exchanging saves you a lot of hassle, but remember, they will pay you less than what the car is valued at, so then they can sell it for a profit. And lastly, always haggle. It can be uncomfortable, but you still might save yourself a few hundred or a couple of grand, and you might even get some extras chucked in for free. If you don't ask, you don't get. For most of us, a car is a need. We need it to get to work so we can earn our paycheck, so we can put food on the table and keep a roof over our families' heads. But we all know of a young soldier, not long out of training, who lives in the block and has no dependents, and goes and buys a brand new expensive car, and half their monthly wage goes to pay for this lovely car on finance, which then sits on camp for 5 days of the week. They are a dealer's wet dream. A secure job, a guaranteed income, low living expenses. Why not try and sell them a fancy expensive car that they don't actually need, but hey, it looks cool. Now, whilst I do personally believe that money would be better allocated elsewhere for future growth, it is their money at the end of the day. If they want to spend half of it on a car that they use to drive home on the weekend, or to Tesco's in the week to buy some microwave meals, then crack on. But hopefully after watching this video, you now better understand the different financing options, and you'll be better prepared the next time you go and buy a car. Going into debt for anything can be a risky decision if you are not careful. Do check out my video on debt and loans to further your understanding of how it all works. Let me know in the comments below of your car financing stories. Do you regret it? Did you get a great deal? And would you do it again? Thank you all for watching. If you liked what you just saw, please hit the subscribe button up there. And if you want to see some more videos, click over there. See you soon.